labor market stays weaker and the Fed keeps cutting, that will be a short-term dollar negative. This year, we know in the second quarter, investors, especially in Europe, decided to sharply reduce their dollar exposure. The current account deficit will stay wide, and we've identified around 4% as a key threshold, beyond which the dollar struggles. So what we've done is we've created all sorts of central bank rules and where Fed funds realized. And the only period where you've had a material deviation was the 1970s, and the dollar then collapsed. So I wouldn't have any reason to think that that would be any different.
I'm joined today by George Saravelos, Global Head of FX Research at Deutsche Bank. George, welcome to Monetary Matters. Good to see you.
Thank you for inviting me, Jack. Good to see you as well.
George, how are you explaining your current views on the dollar to clients?
That's a very punctual question. And I guess the way we start is to think about the relative growth differential. Currencies are always a relative game, so to speak. And if you think about what happened this year, in contrast to expectations, you've had a sharp narrowing. So the US over the last few years has been growing, say, roughly around 3%. And this year we had sharp downgrades to now roughly around 2%, although you've been through a period of upgrades because forecasts were even lower than 2%. And the rest of the world, if you take Europe as a proxy for that, over the last 3 years, Europe hasn't really growing around 0%, slightly above 0%, and it's now around 1%. So that growth differential's narrowed from being as wide as nearly 3% to now about 1%. And I think that's at the core of what's driven dollar weakness. And of course, there's many other things going on. But when we think ahead, the question we ask ourselves is, will that growth differential stay narrow? It's a different way of saying, is US growth exceptionalism over in the way it was present over the last few years? So will it stay narrow, in which case the dollar will maintain its losses and potentially keep weakening, or will it widen back? And the view we have, which I'm sure we'll discuss, is that these growth differentials are going to stay narrower than what they were in the past.
So US will continue to grow faster than Europe, but the delta between the US and Europe is going to narrow. The delta between US and Japan is going to narrow as well.
Exactly. It's a narrower growth gap than what it has been. And over the last few years, it really was exceptional if you're looking at how fast the US was growing versus some of those other major economies.
How do you view the high growth rates of emerging markets versus their relative weakness? Because there are a lot of countries, I believe, Brazil, India, that have higher growth rates than the US, but the dollar has been strengthening against them, not weakening. So is it about the rate of change, or is it kind of different for emerging markets?
Well, it's interesting because emerging markets have actually experienced somewhat of a structural growth slowdown. And if you compare it to where we were in the 2000s or in the 2010s, a lot of these EM economies have been structurally surprising to the downside. But one thing that has happened this year is that EM growth differential as well has stayed relatively robust versus the US. So I think it's all about the relativities, as you say, rather than the absolute levels.
And how long is your dollar bear view? Is it a tactical 3-month view, or are you seeing sort of a secular dollar bear market?
So I think we have to be careful with being in the business of currency forecasting. There's a few key inputs that would go into the medium term view, and at the moment, yes, the view is more medium term. It's that it lasts over the next 1 to 2 years. I would say the growth differential is one driver, which I mentioned. Another, which is absolutely key if you go all the way back to the 1970s, is whether the dollar is a high yielder. And again, if you look back to the last few years, the Federal Reserve has had one of the highest rates in the developed world. And then the third building block in terms of thinking about these medium-term trends is what's going on with the current account deficit in the US and external imbalances. So I guess our view on all these three, both the ranking, the level of US yields versus the rest of the world, our view is that that's going down. The current account deficit will stay wide, and we've identified around 4% as a key threshold, beyond which the dollar struggles. and then the growth gap. So those are the three building blocks to the view. But obviously, there's huge uncertainty around all of these, both around growth and AI, with the Federal Reserve and this question of independence, and the current account itself. When we're thinking about the impact of trade policy, there's so many shocks at the moment going through the system that it's hard to have definitive views on how they'll all play against each other.
Walk us through the Federal Reserve's interest rate cutting cycle, which is ongoing, and the likely and priced in interest rate cuts that are coming in the coming months. How does that shape your dollar bear view?
So there's many ways in thinking about the Fed and interest rates and the impact on FX, and most analysts would tend to think about in terms of rate differentials, and then you'd be thinking about the 2 to 5 year rate differential point, so kind of short to medium term expectations and how that plays out. When you model currencies, you do see that that's relevant on a 3 to 6 month basis. So, of course, if the labor market stays weaker and the Fed keeps cutting, that will be a short-term dollar negative. But if you're thinking about the more medium-term direction, what actually matters a lot more for currencies is the so-called cost of hedging. So this is if you're a Japanese investor or a European asset manager and you're buying assets, how much does it cost to reduce your FX risk? And this one is where the the very short term interest rate differential matters. And here I'm talking about the 3 month forward points, 6 month forward points. And historically, what you see when the Fed is no longer, when the level of yields that the Fed is engineering is no longer in the top three, top four category, that tends to be a very negative signal for the medium-term dollar direction. And the reason is it impacts the stock of assets.
Sorry, George, say that again. Say that last thing you said again. Sorry.
So when the dollar is no longer a top three or top four yielder in terms of very short-term yield. So here I'm thinking about where Fed fund rates are versus the ECB deposit rate. This drives the near-term forward points and the cost of hedging. Your typical asset manager would be hedging using 3 month or 6 month tenors. And when that compresses, that historically has tended to be a very powerful negative dollar signal. And I make this distinction because you can, of course, make the argument that the Fed cutting cycle is priced. If you're looking at market pricing, people already expect Fed funds to go to 3% or below. But it matters what realizes. Even if it is so-called priced in the rate curve, if the realized cost of hedging is going down over time, this empirically does impact hedging decisions. And what I mean by that is, as it becomes cheaper to hedge, you'll see mechanical shifts in hedge ratios. And those are much more important than investment flows because the hedge ratio will apply to the stock of ownership of US assets. And therefore, it can have a much more sustained and medium-term impact on the dollar. So this is why the ranking of US yields in the short term, in the near-term tenors, is extremely important if you're thinking about a medium-term dollar framework.
So the action really is in those short-term interest rates. The US is cutting interest rates. Japan is very slowly raising interest rates. Europe has been cutting, but may stop cutting. And I imagine you would say that the ECB is set to do fewer cuts than the Federal Reserve, or at least that's what's priced in. And therefore, as foreigners buy US assets, you're not saying that they're going to stop buying US assets, but when they buy US assets, an increasing percentage of those purchases are going to be hedged back into the local currency.
That's true as far as you describe. You're describing a flow of funds, but it's also very relevant for the stock of funds. So if you think about your average Japanese lifer, your average European asset manager, they already own a very large chunk of assets. And every 3 months, every 6 months, they have to roll the so-called hedges. And that is what also can change. And that's where the cost of hedging is quite critical.
That's really interesting. So, George, in the stock market, there are these pie charts, these composition charts that show what percentage of stocks are owned by passive or households, hedge fund, and the like. in the currency market, when you talk about what is really moving currencies, there's the currency trading to finance cross-border trade. There is the let's call it speculative trading of hedge funds. There is the actual hedging done by cross-border capital transactions, and then there is the cross-border transactions capital themselves. So whether let's say I'm someone who I'm buying dollars to finance my trade versus the guy next to me is buying dollars because he's a Japanese firm buying a 10-year treasury term, and the person next to him, she's buying the 10-year treasury yield, but she's hedging that back into yen. What is the real mover of currencies between those various factors?
That's a great question, and it's a long time since someone asked me that, because most of the conversations tend to revolve around the Fed and growth, but it's at the core of what drives currencies. And I guess I'd make the starting observation that, in contrast to popular wisdom, so to speak, currencies are probably one of the least efficient markets in the world. And the reason is precisely the one you identified, that you have so many different participants for which profit maximization is not an objective. So the definition of efficiency in the so-called academic literature is profit maximization. And the moment you have market participants that are not driven by profit maximization, that makes the market less efficient. And that's exactly what goes on in currencies. As you said, you have passive investors, you have companies, you have tourists, you have central banks. They don't have irrational objective functions. They just don't revolve around making money trading currencies up and down. So to go back into your question about what is the key flow driver within all those subcomponents, the short answer is it changes every time. It changes every year. And that's what makes currencies notoriously difficult to model. Now, one line of argument would go, that's what proves that they're efficient, because it's not easy to quantify the profit outcome. But I would argue it's the opposite. It's because you have so many shifts in drivers over time and the relevant flows, the marginal shifts in flows, it's very difficult to model that. But if you're in the market in real time, and that's what I'd like to think is part of my job, is to identify those shifts in flows. So, for example, this year, we know in the second quarter, there was a very identifiable flow, very well identifiable flow, where precisely to this discussion on hedge ratios, investors, especially in Europe, decided to sharply reduce their dollar exposure. And this started off as a hypothesis in February, March. And now we have sufficient data to be able to validate that hypothesis, that the biggest marginal shift in the FX market in the first half of the year was this decision, especially by European investors, to lower dollar allocation. Now, no, this wasn't related to the shift in Fed policy and interest rate differentials. It was a discretionary decision on the back of everything that was going on in the first half of the year.
When they're reducing their dollar holdings, how much of it is either selling U.S. Treasury bonds or U.S. stocks, or the equivalent is the marginal savings dollar goes less into those U.S. assets, or is it just we're still going to own a ton of U.S. assets, we're just going to enter into a hedge contract where we're going to be a net seller of dollars?
So I think the way you categorized it is pretty much covers the different types of adjustment. And what we saw was definitely the last one. So an adjustment in the underlying currency exposure, but maintaining the asset. And we have seen a bit of the second point as well. So a reduction in the marginal allocation of dollar inflows. So you have seen a reduction in inflow, and you are seeing the entire stock of assets, a reduction of that the dollar FX allocation. Now, of course, the question mark is what happens going forward, but that's definitely what we saw in the first half of the year.
During the first half of the year, you saw the sharp weakening of the dollar that interestingly occurred alongside a weakness in assets, especially during early April. Since then, the dollar weakness has moderated. What have you seen from the flows in the third quarter, as well as the beginnings of the fourth quarter?
So the data notoriously lagged, which creates a problem, but I guess it makes our life a bit more interesting in terms of trying to take a view on it. We don't have much data on hedging shifts, and this is the most difficult one to measure. We have reasonably good data on inflows and outflows into assets. The data on hedging shifts is very poor, so we have to do a lot of digging. Unfortunately, we don't have data to answer that question. In terms of what we think is going on, I would say still marginal adjustment lower in dollar exposure. And the reason I say that is we can do work to model people's desired dollar exposure. And you can break it down into three things. The first one is discretion, which by definition you can't model. And we saw that happening in the first half. The second one is the forward points. And that's why I spent so much time discussing the forward points, that if they're narrowing, it should lead to additional gradual reduction in dollar exposure. And then the third one, which is a bit more technical, so I won't go into it in detail, is the correlation between the dollar and asset markets, the dollar and equities in particular. So the way to think about this is if the dollar is negatively correlated to your underlying asset performance, so if equities go up but the dollar goes down, the dollar serves as a natural hedge to owning that asset. And therefore, the incentive is to not hedge the FX exposure. But if the dollar equity correlation becomes less negative and even turns positive, then you want to be hedging that. What we've seen over the last year or so is that that correlation is gradually becoming less negative. So the dollar is becoming less of a diversifier, so to speak. And again, that should be reducing the incentive to hold dollar exposure over time. Irrespective of your views around the US economy, irrespective of your views on President Trump, it's a it's the mechanical impact of just the relationship between the two asset classes.
So historically, although I think there was a time when it wasn't true, but over the past, let's say 20 years, often when risk assets would go down, the dollar would go up. So the dollar would be something of a natural hedge, which if you were a European investor invested in US stocks, the US stocks in dollar terms would go down, but the dollar would go up. So somewhat of an offset. Why has that negative correlation been there? And why has the turn over the past few months and quarters been to a less negative correlation or maybe even a positive correlation?
So it's another interesting topic because, kind of alluding to your question, it's often taken for granted that that dollar equity correlation is very negative. But if you go back even 5 or 6 years ago, you'll find periods where it was positive. So it is actually much less stable than is commonly assumed. And I would argue, if you look at what drives that, it's ultimately the source of shocks to the asset class. So let's take equities. If you look at the last 5 years, you have had two major global shocks. You've had COVID, and then you had the Russia invasion of Ukraine. Now, what happens when you get a shock outside of the US that's very big? Equities will go down, but the dollar will rally. Now, when you have a shock that happens in the US, so if you're thinking about the SVB crisis, or if you're thinking about the dot-com bubble, then you can have equities weaken and the dollar weakening at the same time. And so effectively, this correlation is telling you where the source of the shock is coming from. And I would argue the fact that it's been so negative, so the dollar's been such a good diversifier, there's an element of bad luck for the rest of the world over the last few years. It's just so happened you had COVID, and then you had an invasion, the largest since World War II in Europe, which caused the biggest negative supply shock in energy in a century. So some of it is mechanically rolling off these more medium-term correlations. And naturally, that just decreases the incentive to hold dollars. But I'm very cautious of this idea that the dollar is permanently a good diversifier because it doesn't stand up to scrutiny when you look at long time series.
Earlier you referenced forward points. That's just the differential in forward markets between U.S. interest rates and Euro interest rates, or U.S. and Japanese. So that's related to the hedging concept we discussed.
Exactly.
Often during times of true distress, March 2020, 2008, the dollar really does squeeze higher. A common theory, a lot of the literature is that even though the rest of the world is a net creditor to the U.S., that their liabilities are much more sensitive than their dollar liabilities are much more sensitive than their dollar assets. So there is a type of squeeze. Interestingly, we didn't see that in April. Is your view of what we just talked about, correlation, in the tails of those true kind of crises moments? Do you think we ever could see a time when we have a true crisis, VIX 50, VIX 60, high yield spreads 800, and the dollar weakens, which is commonly something that happens with emerging markets?
If you go back to the core of what drives those two periods, so the 2008 and COVID, at the core of it is what's called a dollar shortage. It's not really a dollar shortage. You precisely alluded to the fact that the US is a net creditor to the rest, or rather, the world owns more US assets than vice versa. The issue is an asset liability mismatch, which again goes back to the hedging point. So if you own a treasury that's hedged, you're effectively borrowing dollars in the short term to hedge that dollar exposure, to hold that long-term dollar asset. So what happens during those periods is the market starts to worry about credit risk for banks that are extending those dollar loans that are effectively hedges. And the market starts being concerned about credit risk. You have cross-currency basis widening. So effectively, your forward points not only incorporate the relative rate differential, but the credit risk on dollar lending. And that's when you see that big dollar rally. Now, there's periods where it happens, periods where it doesn't. The key driver is effectively credit risk in Eurodollar markets. That's the offshore dollars that people tend to use to hedge. So can it come back? Yes, I think if the market starts worrying about the banking sector and the stability of the banking sector, it's something that the market hasn't been worried about, partly due to the presence of the Fed swap lines. But I think that is the situation where you would see that dynamic. Now, I guess one last point on this: when you're in a situation where you worry about credit risk, so you have to roll your so-called dollar hedges because you own US assets. So you can do two things. You either roll that asset, so you extend that small dollar loan 3 months to extend your hedge, or if you're really worried, you can actually sell your underlying dollar asset to get rid of that exposure. Now, that latter point hasn't happened. I think there were a few days around April where arguably there was some evidence that people were thinking about that. But I mention it in the context of a broader debate around the stability of the Fed swap lines. Ultimately, the Fed is the provider of global dollar liquidity when that backstop, or it's a provider of a backstop when that global liquidity is in question. And if that process becomes politicized, you may be in a situation where you see the complete opposite dynamics, where if the market thinks it can no longer obtain those dollars for political reasons, it may decide to sell those dollar assets, and then you flip into a very different situation. So this is the interesting part, where the politics starts impacting the plumbing. I wouldn't say we've got there, we are there, or we got there, but we were very close in April to some of these dynamics playing out.
The Eurodollar dynamic is something I've covered many times, that you've just explained it more concisely and clearly than I think I've ever heard. Something, George, that I wonder is, I'm familiar with this theory in the literature from the IMF. The Federal Reserve, they cover in broad terms everything we just talked about, the dollar sensitivity, the dollar borrowers in offshore markets. But George, the few times I go through foreign banks, like, I'm not able to really see the dollar exposure. It appears to me like, Chinese banks mostly lend in renminbi. A lot of European banks mostly lend in euros. Obviously, it's, in South America, there are a lot of dollar borrowers. But where is this pocket of dollar stress that when the dollar funding dries up, they get into so much trouble? Because to me, it's quite hard to find.
Yeah, it's another interesting plumbing question. So you definitely gone into the details there. I think there's the element of the dollar lending, where we're thinking about an average European company that may, instead of wanting to borrow in euros, borrows in dollars, and I'd agree with you there. It's just not that large. And your average European company would want to be doing it in euros. You do see pockets of that in EM, and there are some EM economies that are so-called more dollarized. But if you're thinking about the core of that asset liability mismatch, it's in the FX swap market, it's in derivatives. And that's why it doesn't show up in some of the BIS cross-border banking statistics. You can find it if you dig deep into some of the derivatives and shorter term exposures. But effectively, I think the easiest conceptual way of thinking about it is that if a Japanese investor buys a treasury bond hedged, this is functionally equivalent to borrowing in dollars and lending yen, giving yen as collateral, and then using that to buy the treasury. And the problem lies when there is an inability to keep rolling that 3-month swap. And that's what creates the crunch.
George, earlier you referenced the Federal Reserve swap lines and the politicization of those swap lines. I know in 2008, certain countries that weren't U.S. allies did not get swap lines. Other countries that were allies did get swap lines. So that's important. But it really has taken to a new level, hasn't it? With the Trump administration recently giving a swap guarantee. Actually, I don't think that was not at the directive of the Federal Reserve. I imagine the Federal Reserve might be involved, but that was at the direction of Treasury Secretary Bessent and the Trump administration. But that was to a right-wing populist in Argentina, Javier Milei. You imagine if it was a left-wing populist, maybe the swap line wouldn't be there. So there's that politicization, and then also the rising risk of Federal Reserve independence, with the president being quite vocal in terms of his views of where interest rates should be, namely lower. How does that impact your dollar view and the mechanics of these FX markets?
It's interesting you mentioned those examples because I'd say the market, the starting point should be what is the market pricing around these things. And on the swap line, the market's very clearly applying demarcation between treasury swap lines and the Fed swap line. Now, there is a question mark on whether it's the right or wrong thing to do, but you mentioned Argentina. There's also debate at the moment in Korea. So if you monitor the news flow, there's a discussion around how to implement the trade deal and those investment commitments, and also potential discussion around a swap line for won versus dollars to fund some of those. And the central bank has gone publicly actually just today in that discussion that a central bank swap line wouldn't be appropriate for a trade deal, and it would have to be a treasury swap line. So there's a bit of a demarcation going on, which I would say is at the moment is a positive thing for the market because it still sees those Fed swap lines as being a different thing. But the Korea discussion I think is interesting and potentially more interesting than the one in Argentina as far as how it plays out. But again, this then takes us to the broader question of independence. I'm surprised the market's not attaching a greater probability to a loss of Fed independence. How I define that is quite specific. It's basically a change in Fed reaction function towards tolerating higher inflation. Because we have to bear in mind, we keep talking about Fed independence. Many central banks aren't independent. No one would argue the Central Bank of Russia is independent. In China, the PBOC isn't independent, but they've built up credibility as being allowed to target low inflation. So the question is, does that change? Does the Fed become more tolerant of higher inflation? And the market at the moment is saying nothing will change, despite all the headlines. If you look at the inflation curve, whether you're looking at near dates or very far dates, it's very well behaved and benign, which leads me to how we're approaching it. The fact that it's not priced, to me, just makes it an asymmetric risk that if the market is wrong and the Fed becomes more tolerant, whether because of a shift in appointments and Fed composition, that should lead to a more negative market reaction than the counterfactual where the Fed keeps doing what it's doing, which I think is effectively what the market's already pricing.
And if Federal Reserve independence is lost or will be judged to be lost, the consequences will be a weaker dollar.
So we don't have many observation periods around that, but when that last happened in the 1970s, and again, here I'm measuring it against the counterfactual of, say, a Taylor rule. So what we've done is we've created all sorts of central bank rules and where Fed funds realized. And the only period where you've had a material deviation was the 1970s, and the dollar then collapsed. So I wouldn't have any reason to think that that would be any different unless what you're seeing is a global loss of central bank independence, and then it becomes a question of relativities. But if it's just the Fed, I would have pretty high confidence the dollar would be much weaker.
So you have a negative view towards the dollar. The question is, of course, against what? Let's start with the developed market currencies. What developed market currencies are you most bullish on against the dollar? What are you most bullish on and why?
So there's different ways of so-called slicing and dicing. One is obviously valuation, thinking about which currencies are cheap versus expensive. And if you're looking at those currencies, the yen and Asia currencies in general stand out as being very cheap. So both the yen and the Chinese yuan um, really have not made that much adjustment over the last year or so. Then you have a different metric, which is maybe a more cyclical one. The one we've been very focused on over the last few months is fiscal space. So, which are the economies that have fiscal space to ease policy? And the way we measure that is not in your traditional debt to GDP metrics, because historically we find debt to GDP is a terrible measure of fiscal space. But in terms of net foreign asset positions and reliance on foreign money. And when we look at that, actually, most of Europe looks okay. France is the exception. Scandinavia stands out the most. The Scandinavian currencies have very large external surpluses and are actually deploying that fiscal space. So, question is, who has it? Who's deploying it? So, thinking about the developed world, I'd say Scandinavia at the moment is our top pick. Um, and Asia, but that's mostly a valuation argument, which then goes into discussions around central bank reaction functions again from the BOJ, which is another long story.
So the the Chinese yuan is undervalued. What are the circumstances under which the yuan would strengthen? Presumably one in which the Chinese government blesses that, which could make the Chinese export advantage slightly less potent. Tell us more about the Chinese yuan as well as the case for strengthening in it.
So the yuan is obviously a very unique currency because, to exactly your point, it's not market determined. It's very heavily managed by authorities. So the single most important driver of what would get the yuan stronger would be if the government decides it to go stronger. Now, I wouldn't claim of having any strong insight around that policy intention, but I think we can make a few observations around valuation and to just the broader macro backdrop. On valuation, China's running a massive surplus. It's risen, the trade balance has risen to north of $1 trillion a year over the last pretty much since COVID. And therefore, I don't think there's any debate on whether the currency valuation is too low. Remember, China's been running deflation, so it's been gaining price competitiveness just because prices haven't been rising as much as the rest of the world. So the valuation box is ticked. The policy intent box is the question mark. And here this boils down to what is the driver of growth? And over the last few years, the clear driver has been exports because the property bubble, so to speak, has been unwound. That's exerting a domestic drag. And the key question you have is how much are the authorities willing to pivot to a more domestic consumption-driven type model? Now, what that requires is more fiscal easing, potentially requires higher rates as you're doing that fiscal easing, and also stronger currency because that encourages imports, it encourages consumption. I think that's what the market's uncertain about. We are also quite uncertain about that as a research house here at DB, but our view would tend to be on the more optimistic side that shift is underway, and therefore the incentive to allow for a stronger yuan should be going up.
I know in the first quarter and previously, President Trump has spoken about how a weaker US dollar could help his goals of boosting manufacturing because it gets more competitive. I recently interviewed Brad Setzer, and he made the criticism that actually President Trump over the past few months has moderated that critique, and that you haven't heard much about a weaker dollar. Would you agree with Brad's assertion that a weak dollar policy has not been at the forefront of White House policy?
I think so, and I don't think it's been front and center for a while, actually. If even if you think towards the election and before that election period, when there was various interviews being given, President Trump was actually placing just as much emphasis on the role of the dollar as a reserve currency. He actually, if you do a compare and contrast of commentary in the currency in the run up to the second administration versus the first, there was much. The number of tweets, social media posts were much less, and they didn't talk down the dollar that much. I think the market got very held up with these ideas around the Mar-a-Lago, so-called Mar-a-Lago Accord, but official commentary, both from Trump and Secretary Bessent, has actually not been towards a weaker dollar. So I think there's a bit more consistency there than the market would give credit to. Now, this being said, the dollar has weakened as an outcome of policy, but I haven't taken administration commentary as explicitly talking the dollar down. I think implicitly that may have happened, but I don't, I guess, share the view that many have that the administration's been so aggressively trying to push down the dollar.
So you're bullish the yuan, you're bullish the yen. What about emerging market currencies? For the yuan and the yen, the because it's a negative carry position against the dollar, they yield less. You're going to have to get some appreciation in order to somewhat break even. But with EMFX, it's the opposite. It's positive carry. So if you could be long the Argentine peso and the Argentine peso is only down 10%, that would be a very profitable trade for 1 year. So when you look at the EMFX market, are you as bullish as within pockets of DM? And then also, what are some picks that catch your interest the most?
So I think you raised the point of carry, and that's absolutely crucial for EM, because even if the currency doesn't move, if there's positive carry, you earn that interest rate differential. Now, when we look at what's the key driver behind that, it goes back to what I mentioned before. It's the global growth environment and the growth differential. If you're in a Goldilocks environment where global growth is holding in and US growth rates are not as high that we're talking about Federal Reserve rate hikes or such extreme monetary divergence, the overall backdrop should be pretty decent for EM. So we like carry. I'd say that's more of a cyclical view rather than a structural one, because carry performance is always cyclical. If you look at the global heat map of central banks, pretty much all of the 20 major central banks in the world have been easing rates over the last year or so. As I mentioned, fiscal policy is easy. That should be a relatively benign environment for carry. Now, of course, the biggest risk around that is if you get some of the similar headlines we saw from a few days ago around another escalation. Anything that causes the market to fear global growth, that should be bad for carry. But as long as that's okay, I think carry should be fine. And in that respect, given that it's driven by a so-called global beta, we just like screening currencies that have high real rates and high nominal yields. And that would be mostly, I mean, they mostly sit in Latin America and Eastern Europe rather than Asia, precisely to your point on Asian yields being very low.
Thank you, George. I believe on the Bloomberg terminal, gold, you use the currency symbol, XIU. So gold is, some people still refer to gold as a currency. So because of that reason, I feel I can include it in my questioning to you. In dollar terms, it's up nearly 60% year to date, a historic rally. What do you think is going on? Who are the buyers? Is it mostly central bank driven, institutional investor driven, or retail driven? Presumably, as you go down that spectrum, it gets stronger hands. The strongest hands are in the central banks. And then also location. Rumors of that a lot of the buying is in Asia, China, India. But yeah, how are you evaluating this rally?
It's a huge focus on the investor side. I don't really buy into the debasement idea. There's a narrative that the market's worried around inflation and currency debasement, and that's why it's rallying. If you take a step back, the gold price has been rallying pretty much for the last decade. The dollar has gone up, the dollar has gone down, equities have gone up, down, yields up, down. So what that's telling us is there's a price insensitive buyer out there. And we have done a lot of work to model that. And our conclusion is it's central banks. It's mostly central banks out of Asia, China playing a very big role. And the key trigger point seems to have been the Russia invasion of Ukraine, whereby you had those reserves ultimately sanctioned. And there seems to be a decision taken to just move away from currency reserves to gold. And if you do a chart of the composition of currencies and gold, it looks like we're going back to the 1970s, ironically. Now, back then, you also had inflation, and that's why gold was doing well back then. But I would argue you're not really seeing any other asset class show that same level of concern. To the point on Fed independence, you're not seeing bond markets sell off. You're not seeing inflation break-evens go wider. So it seems to be a decision that's been driven for whatever was the trigger, most likely geopolitics. So from our perspective, the key driver of this has been central banks, and of course other investor types are riding the wave. But we're on the lookout for when that buying stops, because I think that's what would cause the rally to stop as well.
Do you have any early signs that central bank buying is stopping, or at least the rate of growth is going down?
Not for now. Of course, the problem is the data is very lagged as usual. So we will only identify, and we know this, with a lag. But at the moment, it still seems to be going strong.
That's such a great point about how central banks are non-economic buyers. Like, I think central banks were a net seller in the 1970s when the price of gold was extremely cheap. They were a net seller in the 2000s when the price of gold was at $300. And they're a net buyer now when the price of gold is above $4,000. So they don't really have a valuation anchor. And even the thing with gold is, even institutional or retail investors, again, because there is no anchor, it's hard for there to be kind of a ceiling, and hard for there to be a floor on prices. George, thank you so much for joining Monetary Matters. People can find you on LinkedIn. We'll include a link there, as well as you recently launched a podcast for Deutsche Bank. You had a very interesting interview with Michael Pettis, as well as Brad Setzer. I had Brad on, and hopefully I'll be getting Michael on later this year. Thank you, everyone, for listening. A reminder to subscribe to Monetary Matters on Apple Podcasts and Spotify. Leave a review. It really helps the show. And of course, subscribe to the Monetary Matters Network on YouTube. Thank you.
Thank you. Just close this door.